So here we have Nihar sir, and sir would like to mention that across India, I can say from north to south, east to west, many professionals have joined in today's webinar. So all are here to listen to you. Over to you, sir.
Thank you, CA Dipti Jain, Advocate Dr. Kartikeya Shah, Advocate Asutosh Thakkar, and the other speaker, CA Kaival Shah. At the outset, let me thank GyaanStation for giving me the opportunity to share my views on the direct tax-related provisions in the finance bill. In fact, when the budget was presented, just before that, there was an expectation that as the Income Tax Act has come into, or it was passed in August 25 itself, it is possible that this time there may not be many amendments. But when we saw the finance bill, there are more than 100 amendments in the old act. In the old act, there are 27, and the others are in the new Income Tax Act. So all these proposals put together are more than 100, out of which many proposals are just corrections of what was not done in the original act, or where some defects were left, they are corrected. Substantive provisions are not so many. However, if we look at these provisions, many of these provisions have impact on the tax liability of taxpayers in substantial way. So let us start with the rates of tax, where there is no change at all. Just 1 minute, and this slide is not changing. 1 minute, I'll do it again. Yeah. The rates of tax to start with. There is no change in the rates of tax. The rates which are there for assessment year 26-27 will continue for the tax year 26-27. And as you all know, assessment year 26-27 and tax year 26-27 are different. Assessment year 26-27 refers to previous year 25-26. And from financial year 26-27, the concept of previous year and assessment year is no longer there. So now we will have tax year for 26-27. There are no changes, and therefore I'm not discussing this. Again, surcharges remain the same. The only point at which attention is required is that maximum rate of surcharge is restricted to 15% in case of dividends income for residents, long-term capital gains and short-term capital gains, whereas otherwise it can go up to 37%. Another very important point is that you can see in this rate chart, surcharge rate chart, that if the income exceeds 5 crores, the surcharge is 37%. But this applies to assessment year 26-27. For tax year 26-27, this 37% slab of surcharge has been removed. So once the income exceeds 2 lakhs, up to any income level, the surcharge will be 25%. Then for domestic companies, again, the rates of taxes are the same. And along with the cess and the surcharge, the gross rates of taxes are mentioned here. The only change that we see in the current bill is that the MAT credit will be available from tax year 26-27 to those who even opt for the new regime. Whereas up to last year, the provision was that if you have opted for new regime, the old or the past MAT credit, which is left with the domestic company, it would lapse. So the only point which is important is that those companies which adopted new regime last year, that is during say assessment year 26-27 or earlier, if they had accumulated MAT credit, it has already lapsed. Whereas those who will adopt the new tax regime from tax year 26-27, for them, the MAT credit will be allowed to be carried forward, subject to the condition that for any year, the maximum credit that you can take is up to 25% of tax payable for that year. And the balance MAT credit which is left, it can be carried forward for up to 15 years from the end of the year in which the MAT credit was generated. So if 25% of tax payable does not consume the entire MAT credit, you will continue to get it as carry forward, and it can be set off against the future tax years 27, 28 and onwards. Another important point is that if in the tax year 26-27 or thereafter, if a company opts for the old regime, the rate of MAT, the basic rate of MAT will reduce from 15% to 14%. The rate which you see in this screen in the bracket are the rates after adding the cess and the surcharge. So the tax rate for foreign companies continues to be at 35%. So far as tax rates are concerned, there is no change in this finance bill. So we continue with the old rates of tax, although there were some expectations that at least the threshold limit may go up, but it has not happened. Now, again, if we compare these tax rates with the tax rates in the other countries, our tax rate structure is lower than other countries, but our threshold limit is much lower than certain other advanced countries like UK, USA, and others. So it has not gone up with inflation and with time. So that remains to be done, but it appears that the government wants to have expanded tax base and therefore to cover maximum people under the tax net. Perhaps the threshold limit may not go up as much as it is justified by the inflation. Coming to the next very important amendment, in the buyback of shares, the entire methodology of taxability changes. Now, you are all aware that for so many years we have seen that the income arising on buyback of shares has been taxed differently in past many years. So prior to 2000, on buyback of shares, only capital gain was taxable. Then in between, from 2000, 2013, the law changed. And on buyback of shares, the amount paid to the shareholder was treated as dividend. And it was taxed under the head income from other sources as dividend income. And even up to assessment year 26-27, whatever amount the shareholder receives from the company on buyback of shares, it is taxable as dividend and it is covered in the definition of dividend. There is no capital gain tax, but the entire cost of the shares, which are bought back by the company, it is allowed as capital loss. Now, depending on the period of holding, this loss can be short-term capital loss or long-term capital loss. In a number of cases we saw in the past, that where particularly the shares were held for more than 1 year and they were of listed companies, the loss was long-term capital loss. And if there was no long-term capital gain, this loss got carried forward and over a period it lapsed. So it did not help at all. And the gross amount received on buyback of shares was fully taxed as dividend income. And this was unfair. Now, again, from tax year 26-27, the government wants to change the entire methodology. And from the next year, on buyback of shares, amount received will not be treated as dividend, and therefore it is proposed in the bill that amount received on buyback of shares is taken out of the definition of dividend income, and provisions are incorporated in capital gains to provide that the difference between what a shareholder has received on buyback and the cost of the shares will be treated as capital gain, long term or short term, depending on the period of holding. Now, this is good and fair enough, and shareholders on buyback of shares will pay tax as you see in this first column, normal rate of tax 12.5% if it is long term, 20% if it is short term, and if the shares are of listed companies, and if it is short term and shares are of unlisted company, then applicable rate of tax. But from tax year 26-27, they want to tax promoters differently. Now, again, before we come to this additional tax which is payable by promoters, one more point which is important, that up to assessment year 26-27, on buyback of shares, the income is taxable as dividend income, provided the buyback is under Section 68 of the Companies Act. We also know that under Section 230 of the Companies Act, a company can reduce share capital with NCLT approval. And if there is reduction in share capital, and on reduction, if company pays any amount to the shareholder, it will not fall within buyback. And in that case, the income would be taxable under the head capital gain. This was the position, or this is the position up to assessment year 26-27. In the new act, it is provided that buyback will include buyback under Section 68 of the Companies Act, or even capital reduction under Section 230 of the Companies Act. So now there will not be distinction. Any shares which are bought back by the company and cancelled, or any shares which are directly cancelled and then amount is paid to the shareholder, it will be treated as buyback. Now you can observe in this table that in the case of promoters, if promoter is a domestic company, on long-term capital gain arising from buyback of shares, if the shares are listed, additional rate of tax will be 9.5%. And if the shares are unlisted, gain is long-term, again additional tax rate will be 9.5%. But if the gain is short-term and shares are listed, additional tax rate will be just 2%. And if it is short-term and shares are of unlisted company, then only applicable rate will apply and there will not be any additional tax. If the promoter is not a domestic company, promoter is an individual, HUF, or any other category of person, then the additional tax will be higher at 17.5% and 10%, as you can see in this table. Now, the only question arises, is there any way out of this? Can one escape the additional tax? What we can see is that suppose our transaction does not fall under the GAR. GAR has a threshold limit. Then one can make an attempt to plan if promoters would know the buyback uh, decision to be taken much in advance. So the question is, if suppose a promoter just before the buyback transfers his shares to a close relative at the buyback rate, because approximate buyback rate would be known, then there will be only long-term or short-term capital gain. There would not be any additional tax. And then when this close relative, who would also become a promoter on acquiring the shares, on buyback, that company effects will not be required to pay tax because this relative has purchased the shares at higher rate, almost at buyback rate. So there won't be additional tax if there is no capital gain. Again, see, if this is done just before the buyback, this would look like a situation where the entire transaction was done only with the intention of avoiding tax liability. But if this sale is done by the promoter more in advance, say 6 months or a year in advance, before the buyback, it may not be covered by GAR. Again, GAR has a threshold limit. So if the transaction or the income does not cross the threshold limit, then GAR would not be attracted. Otherwise, one will have to be careful and do the planning after considering the GAR implications. But this additional tax is not understandable. Why this additional rate of tax should be charged from the promoters? But that is the provision which is being proposed, and it may get passed, and the promoters may face this additional rate of tax. Now, let us come to the other provisions. And charitable trusts, many chartered accountants deal with charitable trust taxation. Under the new act, charitable trusts are known as NPOs, non-profit organizations. So when the new act was passed, that is 2025 act was passed, certain benevolent provisions which existed in the old law, 1961 act, they were not incorporated in 2025 act. So now through the finance bill, in these three amendments, what we can see is what was not done earlier and which was required to be done. And it was not done because there was no intention. It is not that way, but it was left out. So it is being done now. Let us discuss them one after the other. One is insertion of provision related to merger of NPOs. We know that under the old law and new law, if a charitable trust exits, that is, gets dissolved, it will be subject to accretion tax at fair market value of the assets lying with it at the time of exit. And this would be heavy tax liability. So under the old act, a via media was provided by the act itself that if you don't want to continue the charitable trust, the trust can get merged with any other existing charitable trust which is registered under the Income Tax Act. And this facility was allowed, or it is allowed, by Section 12 AC of the Income Tax Act 1961. There was no parallel provision in the Income Tax Act 2025. So now it is proposed to insert Section 354A in the Income Tax Act 2025 to provide that merger of NPOs will be allowed. NPO is the new name of charitable trust. So merger of NPO will be allowed. And now, therefore, the existing NPO, which wants to stop its activities, need not exit, but it may get merged with an existing NPO which wants to continue and save the accretion tax. Another amendment is also for what was left out, amendment relating to specified violation. See, under the 2025 Act, Section 351 provides that, and it is corresponding to Section 12AB of the old Act, that if a charitable trust, if an NPO engaged in carrying out objects of general public utility and it carries on commercial activities in violation of Section 351, then it will be regarded as specified violation. Now, if it is regarded as specified violation, what is the implication? This will lead to cancellation of registration of the NPO. And this would really bring in high rate of tax for the NPO if registration is cancelled. And if an NPO engaged in general public utility activity, if it carries on commercial activity beyond 20% of gross receipts, if the income from commercial activities exceeds 20% of gross receipts, such income is liable at higher rate of tax. So already that punishment is there. There is no need to include this violation under specified violation and make this to lead to a situation where registration would be cancelled. So now it is proposed to amend Section 351 and take out this violation from the list of specified violations. So from tax year 26-27, if such NPO carries on commercial activities, it will not be regarded as specified violation. Registration would not be cancelled. The third amendment which is being brought in is that under the existing provisions of 2021 Act, NPO cannot file belated return if the time limit specified under the old Section 139 parallel to Section 263 of 2025 Act. If the time limit under subsection 1 is gone, the NPO cannot file belated return. Now it is being provided by amending Section 263, subsection 4, that NPO can file belated return even after the due date specified under Section 263. So all these three amendments are now proposed to correct a situation which was not desired or intended while passing the 2025 Act. So one may note this. In fact, you will remember that when we were discussing the differences between the old law and the new law, we had discussed these three distinctions, and everybody had a concern that if merger is not allowed, if carrying on business or commercial activity is considered a specified violation, if belated return is not allowed to be filed, it will lead to hardship to the NPOs. So these amendments are being made to remove the hardship and put the provisions of 2025 Act at par with the 1961 Act. Then if we go to the next amendment proposed, it is in income from house property. The provision of Section 21(5) in the 2025 Act provides that if an immovable property is held by the SSE as stock in trade its annual value will be taken as nil for 2 years. In fact, why this limit of 2 years is given? In the case of normal stock in trade, generally it would be sold within 1 month, 2 months, or 3 months. But immovable properties, although held as stock in trade, although constructed for resale, sometimes it takes more than 1 year to sell. So it was intended to provide time limit up to 2 years for such immovable property to be treated as stock in trade. But by mistake, they put the word for, that it will be treated as stock in trade for 2 years. Now they are amending it and providing that such property will be treated as stock in trade up to 2 years from the end of the relevant financial year in which the construction is completed. So if the property is sold within 2 years, there is no question of treating it as stock in trade. Then another provision, again, it is being brought to correct a situation which was not intended. We know that in computing income from house property, whatever interest is paid on borrowed money for the relevant tax year, it is allowable as deduction up to a limit of 2 lakhs of rupees. There is a ceiling limit of 2 lakhs. But if any interest liability pertains to the years during which construction was going on, then we know that interest for the construction period is allowable over a period of 5 years from the year in which the construction is completed. So currently, if you read the provision of section 22, it will lead to the conclusion that the ceiling limit of 2 lakhs applies only to current year's interest on borrowed capital. The 1/5 of the interest for pre-construction period, which you set off during the post-construction period, it is not subject to this limit of 2 lakhs. This was not the intention, and therefore they are clarifying that this 2 lakhs of rupees ceiling limit is for both the interest put together, interest for the current year and interest for the pre-construction period. So again, one will have to keep this in mind. One more amendment which we had suggested is that if you read the new act, under the new act, if a person holds immovable property on lease basis and the lease period exceeds 12 years, then the lessee is deemed to be the owner of such property. Now, if such a lessee sublets the property and receives rent, then he receives rent from the sublessee and he pays rent to the owner of the property. If he is deemed to be the owner of the property, rent that he pays to the owner would not be allowable as deduction. So it was requested that a specific amendment be brought to allow rent payable to the owner of the property by a lessee holding property for more than 12 years lease period. However, this amendment they have not brought in. We'll have to go on pursuing and see that this difficulty is removed. And this can happen only by the amendment of the provision. Let us go to the next one. Income from business or profession. Now here there is one good amendment as compared to the existing provision even under the old act. We remember that employees' contribution to provident or other fund is allowable as deduction to the employer only if it is deposited in the provident fund or other welfare account of the employee by the due date under the relevant Act, and due date under relevant act is some day in the next month after the month of deduction. If it is not paid by the due date, under the old law, under section 36 15A, it was never allowable. So even if it is paid after the due date, it was not allowable at all. Under the new act, parallel provision is in section 29E1 of the 2025 Act. It's exactly similar provision. Now they want to give some relief, but again, it is not full relief. Let us see what relief is given. Under the amendment which is proposed, it is proposed that even if this employee's contribution is deposited in the welfare fund by the due date for filing the return of income, it should be allowed as deduction. But the question remains, although we have got some longer period to deposit, instead of just next month, one can deposit up to the due date for filing the return of income and still claim deduction. What happens if this amount is deposited after the due date for filing the return? If it is deposited after the due date for filing the return, it is never allowable. And that situation continues. Now, against this, if you compare the provision for allowing employer's contribution to this welfare fund, it is allowable in the same previous year if it is paid by the due date for filing return. And if it is paid after the due date for filing the return, then it is allowable in the year in which it is deposited. So employer's contribution would be allowed even next year. But employee's contribution, once it is delayed beyond the due date for filing the return, it will never be allowed. Let us see the next provision. Those whose properties, land or building or land and building, are compulsorily acquired by the government in public interest, the capital gain arising on transfer, on compulsory acquisition of this land or building is exempt under section 96 of the right to fair compensation and transparency in land acquisition, rehabilitation and resettlement act. But there is no provision for exemption in the Income Tax Act, neither under the old law nor under the new act. So now they are proposing to provide in section 11 of 2025 Act deals with exemptions. So capital gain arising on transfer of compulsory acquisition of land by the government is now incorporated in section 11 and also in schedule 3. Schedule 3 gives a list of all exemptions which are available. So this is being added there. And many taxpayers did not know that under section 96 of the Right to Fair Compensation Act, there is a provision for exemption of capital gain. Now that it is provided in the Income Tax Act, it will be within the attention of all. Not only that, there were certain drawbacks under section 96 of RFCT LARRA. There certain compulsory acquisitions done by certain authorities listed in fourth schedule were not eligible for exemption. Whereas here in schedule 3, what they are proposing is that when any land is compulsorily acquired by the government or any authority like National Highway Authority of India or any such government authority, all such compulsory acquisitions, capital gains arising on such acquisitions will be fully exempt. Whether the gain is long term or short term, it is fully exempt from income tax. The next amendment is being done to extend the period of exemption or deduction which is being presently granted. Under 1961 Act, Section 80LA, under 2025 Act, Section 147 provides that the units in IFFC and offshore banking units are eligible for 100% exemption on certain incomes. IFSC units are eligible for exemption for 10 consecutive years within 15 years, and offshore banking units are eligible for deduction for 10 consecutive years from the first year of operation of the OBU. Now, this time limit of 10 years is being extended to 20 years. And in the case of IFSC, the total number of years from 15 years, it is being increased to 25 years. So it can claim deduction for 10 consecutive years in a period of 25 years instead of 10 and 15. Again, one more concession is being extended. It is proposed that the business income of units in IFSC after the expiry of the period of deduction will be taxed at the concessional rate of 15%. It will not be taxed at full rate of tax. So a substantial concession in terms of deduction is being extended to the units in IFSC and offshore banking units. This is just extension of the number of years. There is no other amendment in the provision itself. Then certain amendments are proposed to bring in ease of doing. Let us look at these proposals. One is electronic procedure for lower deduction certificate. Now, at present, when we apply for lower deduction of tax certificate, we have to make an application to the jurisdictional officer physically and get it from him after satisfying him that the person applying is eligible for lower rate of tax or no rate of deduction certificate. Now they are proposing that one can file this application electronically. Even verification will be done electronically, and lower rate or no rate deduction certificate will be issued virtually. So if this is done, this is very good. We have received refunds on fast track after it was automated. In the same manner, if the certificates are issued in autopilot manner, it is a very good step that they are taking. But let us hope that it will be practiced in letter and spirit. And by taking out some defect, if this certificate is not granted, physical presence will not be required. Another amendment is being done to facilitate payment of TDS without obtaining 10. We know that at present, any purchase of immovable property from a resident buyer attracts TDS, and this TDS can be paid by the buyer without obtaining 10 number. So this facility is available. But if you buy immovable property from a non-resident, there is no such exemption from obtaining 10. You will have to not only deduct tax at source, but also apply for 10. Now, it was realized by the government also that tax is deducted generally by an individual and such persons on purchase of immovable property, and it is a one-time deduction, one-time payment. They are not required to do this frequently, and therefore the requirement of obtaining 10, even when property is being purchased from non-resident, they are removing now. So that is another amendment, but it will come into force from 1st October 26. Another amendment which is proposed for ease of doing is that on supply of manpower, when you make payment for supply of manpower to a contractor, today there is a dispute with the tax department whether it will be considered as payment done for work done, and therefore whether it will attract concessional 1 or 2% rate of tax. And department has taken stand that it is liable to 5% or 10% rate of TDS. Now they are proposing to provide specifically that any payment made for supply of manpower will be treated as payment for work done. And therefore, if individual or HUF is making the payment, the tax rate will be 1%. If the deductor is any other person, deductee is any other person, then the TDS rate will be 2%. The fourth amendment which is being proposed again is, you know that at present, if you pay interest to a bank, we are not required to deduct tax at source. But if interest is paid to a cooperative society engaged in banking business, if we obtain loan from cooperative society engaged in banking business and pay interest, it is liable for TDS. Now they are amending section 393 subsection 4 to provide that where interest is paid to a cooperative society engaged in banking business, no TDS is required. Again, a benevolent provision. All these four provisions will go for ease of doing and will facilitate taxpayers. Let us go to the next one. At present, if you are an investor and you have invested through a depository, you are required to give declarations in form number 15G and H separately for dividend income, interest income, and income from mutual fund. Now what they are providing is that the investor SSE can provide declaration to the depository in a single declaration for dividend income, interest income, and mutual fund income. And then depository in turn will share this information, share this declaration with the relevant payers of such income. For dividend, company would be the payer. For interest, dividend, a company or any other person may be the payer. And for mutual fund income, the payer would be different. So now there is no need to file these declarations separately with each payer. File it in one declaration with the depository, and depository will share this declaration with the different payers. Again, it will go towards ease of doing. This amendment is being brought in from 1st April 27, that is after a lag of about 1 year. Probably they want to make changes in the softwares in such a way that this information can be seamlessly shared by the depository with the different payers and need not be done physically. So that may take some time, for which they are allowing this facility from 1st April 2027. The next amendment is in the rates of TCS. On the right hand side, you see all rates are at 2%. That is under the finance bill. Now, proposal to reduce or increase only to make the tax TCS rates uniform at 2%. At present, on sale of alcoholic liquor, TCS is 1%. Under the amendment from 1st April 26, it will be 2%. I think this is the only rate which has been increased. On sale of tendu leaves, currently it is 5%. It is being reduced to 2%. Remittance under liberalized remittance scheme. So if the LRS is for remitting educational loan, there is no TCS at present and no TCS is proposed by the finance bill. So there is no change in that. But for any other TCS where the TCS rate is 5%, now it will be 2%. And on purchase of overseas tour program, at present, if you take the package up to 10 lakhs of rupees, TCS is 5%. If it is above 10 lakhs, it is 20%. Now this threshold of 10 lakhs is being removed and there will be flat rate of 2% when you make payment for any overseas tour program. So from 5 and 20%, it is being reduced to 2%. Now, these three deductions or exemptions which are being provided, when you read it, it is not very clear as to who will get this exemption and how. But in all these three provisions, the scheme is yet to be drafted by the government. So scheme will come up which will clarify the situation. But let us understand what is the proposal. The proposal is to exempt the income of non-resident in case of certain facilities or services provided. So let us see three of them one after the other. The first one is the exemption is available to a foreign company who is providing capital goods, equipment, or tooling to the contract manufacturer for use in electronic manufacturing in India. We know that the government is promoting manufacturing of semiconductors, electronic goods in India. For this, if tools or capital goods or equipment are provided by a foreign company and it earns income out of provision of these goods, its income will be exempt. The conditions are that the ownership of such goods will remain with the foreign company, but the control of this capital goods will remain with the contract manufacturer who is resident in India. The contract manufacturer is located in custom bonded area. The contract manufacturer produces electronic goods for supplying in the foreign country. Such exemption shall be available up to tax year 3031. So it's a long-term provision. Now, the first question that may arise in mind is that if the ownership of these capital goods, equipment, or tools is going to remain with the foreign company, what will the foreign company earn? It will earn lease rent on supply of these goods for use by Indian contract manufacturer. And it is this lease rent which is sought to be exempted from tax in India. In fact, for a foreign company which does not have a P in India, if it earns such lease rent from supply of these capital goods, whether it is taxable or not is a question mark. Only if it is taxable, the exemption makes sense. So let us look at the scheme which will come, which will provide all conditions. But at present, whatever income this foreign company earns by providing such capital goods, it will be exempt in India. And the foreign company's status as non-resident will continue. The next exemption is sought to be provided to those individuals who are non-resident for a period of 5 consecutive past years, non-resident. Now, in a particular tax year, the individual comes to India, he visits India for the first time for rendering services in India in connection with any scheme as may be notified by the government. So again, there is a suspense here. What kind of services this non-resident individual will come after visiting India and after coming here and staying here? So that will be again reflected in the scheme, and we will have to see what kind of services are covered. Now, such individual during the relevant tax year should render these services. Exemption will not be available beyond a period of sorry, this has gone. Can you see the presentation? Somehow it has skipped from my slide.
Sir, it is visible.
It is visible.
Yes.
एक minute, 1 minute. Somehow I will. So, and this exemption will be subject to conditions to be prescribed. Now, once this individual becomes resident in India, the exemption will work as per the scheme. Now, the scheme would see the person would become resident in India after 1 year. And if he becomes fully resident here, even his foreign income would be taxable here. So, what is sought to be provided by introducing this provision is that his foreign income will not be taxable here. But again, complete clarity will come from the scheme that what this individual is supposed to do here, what kind of services. Naturally, some technical services are supposed to be imported. So let us see when the scheme comes, what kind of exemption is being proposed. And the last one is to a foreign company, any income accruing or arising in India or deemed to accrue or arise in India by way of procuring data center services from a specified data center. So if you look at conditions, the data center is to be set up here, but the investment in data center will be done by the foreign company. Data center will be run by a resident Indian or a resident company, and physical infrastructure will exist in India. It will be provided by foreign company, and whatever income it earns out of this data center, it will be exempt from tax. As I mentioned in the beginning, that to understand these exemptions fully, we will have to look at the scheme which the government will announce separately. And it is being indicated that in another 2 months, these schemes will come out. At that time, we need to discuss all these three provisions again in greater detail as to what conditions are to be satisfied, what category of income will be exempt, and how the affairs of such foreign company or non-resident coming to India will have to be planned to avail this exemption. The last exemption is supposed to be provided up to 31st March 2047. That is the year by which the government is expecting India to become Viksit Bharat. The next amendment is to extend the due date or the date for filing belated return. Sorry, the due date for filing return. At present, those persons who are not subject to tax audit are required to file their return by 31st July of the relevant assessment year. Under the new act, by 31st July of the financial year immediately following the tax year. Now they are providing or proposing to provide that for SSE not liable for audit, but who has got business income will be required to file return by 31st August. So this 1 month extra window is being given to those taxpayers who have business income, but who are not required to get the accounts audited. And the amendment will be effective from 1st of March 2026. So it will apply to even assessment year 25-26. Because when a provision comes into effect from 1st March, it applies to the relevant assessment year. Then for filing revised return, at present you can file revised return by 31st December of the next following year. Now it can be filed by 31st March, subject to payment of extra fees. Now I think it is 5/7. Diptiji, how much time I have, or I have exceeded time, and should I conclude now or continue? Because as such, there are 100 plus provisions, so 1 hour is not adequate to complete. But most of the provisions which are substantial, we have finished. So if you let me know how much time I have, accordingly, I will cover 1 or 2 important provisions and conclude. Yes, anybody can tell me how much time, or I will continue till you tell me that now time is over.
Yes. So if you can take, as we have got our next speaker also with us.
Yeah.
So
Yeah.
if you are okay, we can like share the presentation. I would like to
Yeah.
know like how many, if something important is left out, we can cover those important changes. Else we
Yeah.
can take up the question answers.
Sure. So what I can
कुछ
do is
हाँ जी
provision related to that unexplained cash credit, I can cover.
yes sir.
Others, all these are peripheral, like not difficult to understand. So this particular slide I will cover. After that, if you want to invite questions, you can invite questions.
So yes sir.
Yeah. So see, at present, if any unexplained cash credit investments or unexplained money or unexplained expenditure is declared or found by the officer, the rate of tax applicable will be 60%, surcharge applicable will be 25%, and the cesses will be 4%. Along with surcharge and the additional tax liability under section 271 AAC of the old Act and section 443 of the 2025 Act, it will be 78% plus 6%, 10% on 60%. So 84% will be the tax liability, plus it will be liable for even penalty. So now now this 60% rate was brought in at the time of demonetization. But now things are normal, and what they are proposing now is to bring this tax rate to, I think this slide changed suddenly. So now they are bringing the tax rate to 30%. And at the same time, so the maximum rate tax payable will be 39%. And it will be subject to penalty if unexplained cash credit, investment, asset, expenditure is detected by the officer. But the facility for going for or applying for immunity is being now extended to such kind of additions. So by paying 120% of tax, you can avoid penalty under section 443, which is parallel to, sorry, 439, which is parallel to section 270A. So this is substantial relief which one may note. And this provision uh, you can make use of, particularly if anybody has undeclared income and wants to deposit cash in bank and declare it in the return of income itself. If you yourself declare, there won't be any penalty, but the total rate of tax will be 39%. So if the taxpayer feels it appropriate to declare it at 39%, this facility the taxpayer can avail. So these are some of the major provisions that I thought I will deal with. And if there are questions, I will be happy to answer. And I have already shared this PPT with you, which you can circulate to all the participants.
Yes, sir. Sure. So we have like one question. Will interest on compensation also exempt, and payment of interest still require TDS if paid to NBFC? Is there any relief in this?
No, there is no relief in that. Actually, when they provided that interest payable to cooperative society in banking business is not liable for TDS, they should have provided at the same time for NBFCs also. And it is very difficult to deduct tax from the EMI that you pay to NBFC, because they collect EMI at fixed rate, and then you have to apply to NBFC that you return the tax deductible which I can deposit, and it will be reflected in 26 years. So here it is not ease of doing, a lot of difficulty, and rightly we can demand and bring to their notice that payments to NBFC should also be covered by the exemption. It is not covered by the amendment.
So there are like many questions, but we have the time constant. So what I can do, if you can WhatsApp me, I will pass on those queries to the sir, and whatever reply he gives to me, I'll share with you.
I will be
Yes.
happy to send reply on email or WhatsApp,
Yes, sir.
which you can share with the person who has asked or
Yes.
with everybody.
Yes, yes, sir.
Yeah. So I thank GyaanStation, particularly Deepti ji, for giving me this opportunity. It was pleasure sharing views on the finance bill. Thank you so much.
Thank you so much, sir. And now I request Darshit Shah, the managing committee member of GSTBA, to please give the formal vote of thanks. Over to you, Darshit.
Thank you, ma'am. Am I audible?
Yes, please.
Respected dignitaries and valued participants, on behalf of the Gujarat State Tax Bar Association and other tax bar association, I extend our sincere gratitude to CS Nihar Jambusaria sir for the insightful address on Union Budget 2026. Sir, your clear analysis and practical perspectives help us to understand the key provisions and their impacts. We truly appreciate the time and effort you devoted to sharing your expertise and the clarity with which you highlighted opportunities and challenges ahead. Sir, thank you once again for your enlightening us and making this session meaningful.
Thank you. Thank you.
Thank you
Pleasure.
so much, Darshit. Wonderful. And Ashutosh ji is also here with us, the president of All Gujarat Federation of Tax Consultant. Sir, if you can speak just two sentences for today's session, as we have got the next topic lined up with us. Over to you, sir.
Yeah, थैंक यू सर। पहले तो आपने जो आपका जो प्रॉपरली एनालिसिस था वो एकदम अच्छा था। ये बजट एनालिसिस आज की डेट में बहुत रिक्वायर्ड था, और आपने जैसे एनालिसिस किया इट्स अमेजिंग। और जो भी टैक्स हमारे प्रोफेशनल्स हैं, जो हमारे ब्रदर्स हैं, जो हमारे मेंबर्स हैं, उनके लिए बहुत अच्छा रहेगा। एंड न्यू जो हमारे अहमदाबाद के ही हैं सीए केवल आई विश के भाई उनका भी जो भी अपना सेशन रहेगा बहुत अच्छा आपके लिए मेंबर्स के लिए बहुत अच्छा रहेगा। थैंक यू। या
Thank you so much. And now I request we have with us CA Cavalier Shah. So we have Hi Cavalier, and here is Shivam with us to introduce Cavalier, our next speaker. Over to you, Shivam.
Thank you, Dipti ma'am. It gives me great pleasure to introduce our today's speaker and my dear friend CA Keval Shah. Keval Shah is an independent investor and NISM certified research analyst with nearly a decade of hands-on experience on equity markets. Beginning his investing journey at the age of 20, he focused on identifying the future leaders at an early stage with the core expertise in long-term investing, portfolio construction, and stock selection across public and private markets. A chartered accountant at 21, he holds specialized ICI certification in forensic accounting and fraud detection, ISA, and concurrent audit of banks, along with Master in Commerce completed 22. In 2021, he was recognized as the Pro CA of Ahmedabad by the ICI Ahmedabad branch. Beyond investing, he is a passionate educator and content creator, sharing his research methodologies and market insight through his YouTube channel CA Keval Shah, and guiding aspiring investors with his discipline and independent approach to equity investing. Thank you. Over to you, ma'am.
Thank you, Shivam. So yes, Kevali with us. Kevali, you would like to share PPT or direct as per your flow, you can take the session. The dais is all yours. Over to you.
Yeah, all right, thank you. Good evening, everyone. Am I clearly audible to all?
Yes.
All right, perfect. So first of all, thanks a lot, Dipti ji and the entire GyaanStation team for providing me this opportunity of sharing my thoughts on the Union Budget 2026 and specifically its impact on the stock market and the portfolio of every one of us, right? So as a professionals, we all are like invested into equity market, and it's very essential to understand that how it is going to impact the portfolio of each one of us and how we could essentially take the advantage of this budget and take the strategic call of the your wealth management journey for the next decade or for the year of 2026 to 2030. So even before I begin with the session, first of all, I would like to share thanks to the Nihar Jambusarya sir for sharing all his thoughts about the impact of the budget on the direct tax. And now, when we are beginning for this session today, I would just like to, before we start with the session, I would just like to clarify that we are here not for any of the stock tips or to create hype. My job over here is to give you a framework that how to think after this budget, how to read all the signals, and how to position your portfolio for 2026 and beyond. Now, if I have to summarize this budget in one line, it is this. Budget 2026 was not a headline budget, and it is a compounding budget. And we all know that it was on the Sunday, 1st of February 2026, and the market's first reaction was very emotional. We had all seen that there was extreme carnage in the market, but essentially, friends, the story really sits in the fine prints. And for the next 40 minutes, whatever time we have, because we would strictly follow the timelines and we would be going to complete the session before 6 p.m., what we would be going to do is we would go and walk through the following four agendas, right? First is what's happening in the market right now, where we are right now, what is the setup, what is the currently Q3 FY26 numbers coming up, how is the valuation looking like right now, and how we could position our portfolio from there. Second, we would be going to talk about what budget 2026 actually changed, like beyond headlines. We would not be going to touch upon the headlines, but how budget actually 2026 has changed the numbers, how has been the allocation, how you could see for the sectoral rotation and all those stuff. Third, we would be going to see that what are the real multi-year opportunity pockets available. We would not be going to talk about much of the stock specific things or the company specific things, but we would be going to talk about the sectoral level things, right? And fourth and the last, but the most important thing, we would talk about the practical portfolio strategy framework for 2026 to 2030. And before we begin, and before I share with this my own screen, a quick disclaimer and an important disclaimer I would like to share with all of you, that this entire next 40 minutes would be the purely educational discussion. It would not be the investing advice or the portfolio restructuring advice. You have to essentially do your own due diligence. And I could at least guarantee and assure you that if you are a CA or a professional investor or a professional, I'm sure that you would be going to appreciate the entire discipline lines that we would be going to follow. And if you are a retail investor, you would going to really appreciate the clarity lines that we would be going to discuss over the next 40 minutes. With this, I'm going to share my screen with all of you. Just bear with me that I had not got enough time to prepare the presentations. So I would just quickly run through a few of the PDF documents. I hope that would be fine. So I'm just sharing the screen with all of you. Just let me know if the screen is visible to everyone. Is my screen visible to everyone?
Yes, it is visible.
All right, perfect. So first, we would be going to talk about the macro outlook and what exactly it is running right now. Right. So first, we are going to talk about the market state currently, right? So we all know that the market currently is not in a great mood, and this conversion really matters the most, right? So what essentially we would be going to study is the real data and the fact that how the current market looks like. So this is something a very relevant and important data point which I would first like to share with all of you. And we would try to understand all of these data points in the most simple language so that it don't become much of the technical things, but at the same time it gives you the a very clear view of how you could understand the current market scenario. Because without understanding the current market scenario, you would not be able to really understand the framework that we would be taking up in the point number 4. So if we just scan all the stocks that are in the equity market universe in the Indian stock market, what we could see essentially right now is that 23% of the stocks currently are only about 10-month exponential moving average, or even less than 23% of the stocks right now are currently trading about 10-month exponential moving average. And along with this, there are only 20% of the stocks currently in the entire universe which are trading above the 40 weekly exponential moving average. Now, what does this essentially justify and showcase? Now, 40-week exponentially moving average is essentially considered as the stage where the stocks are in a technical strength, or the stocks are essentially in the technical upward zone. But right now, only 20% of the stocks are above 40 weekly moving average. So what we understand from this thing, that right now the market is extremely narrowed, it is tired, and most of the stocks are not in the strong uptrends. Now, this typically happens not at the top of the cycle, but closer to the reset phase. Now, you all understand that what we mean by the top of the cycle and what do we mean by the reset phase. And what we essentially need to understand is that the same deck also shows we are moving from low volatility to high volatility. But there is essentially one thing we all need to understand, that there is a special investor advantage available with all of us when this scenario comes up. So what we need to understand over here is that when the stocks had corrected significantly, what we could see right now here is that most of the stocks has essentially come into the accumulation zone, which is technically called the high opportunity zone. सो आप यहाँ पे ये समझ सकते हो कि जब सारे स्टॉक्स अपने 40 वीकली मूविंग एवरेज के नीचे ट्रेड कर रहे हैं, it is essentially in a very high accumulation zone. So it is a very high opportunity capabilities or the possibilities available right now. And for this thing, also I would like to share one detailed presentation or one detailed note which is in the other deck. so that you could be able to understand this thing in a very detailed manner, that what's really happening right now. So what we are understanding right now is that, okay, so let me explain this thing to you in the simple manner. All right. So this is something, a very interesting data point, which I like just read a day before yesterday, and I would like to share it with all of you. So what we could see in, and this is really very important to understand the current market context. So even if you are an investor or in like positional trader, you must need to understand this thing. And trust me, once you understand this current scenario, it would be going to help you extremely in building your portfolio or in preparation of your investing framework for the next 12 to 18 months of time frame. Now, so what is the context right now? The Indian markets, we all know that it has significantly underperformed all the global peers for all the last 16 months due to a perfect storm, which was the tariff and the Pakistan war. And due to all those things, what we could see is that we had seen the $23 billion of outflow in the last 16 months. But there is a significant disconnect of index versus the small cap and the mid cap portfolio. And now this disconnect essentially showcase what we could see is the signals that has been happening in the last 3 months, and how we could connect all of these things and we could develop a opportunity that would be really interesting to understand. All right, so this is something we had already seen, that in the last 6 months, that has been a perfect storm. We had seen the tariff shock, which was like 50% US tariff on India, which had been just like in the last week had been reduced to 18%. Now, what is interesting to see is here that if we see the index is just 3 or 4% away right now, which is the Nifty 50 index, away from its all-time high. But if we see the real pain, which is in the median BSE small cap returns, so what we could see is that the entire small cap returns is almost down by 30%. And this is a significant correction. We all of us are also would be what all of us would also be feeling in our own portfolio. Now, this is something is very interesting, that what happens is that due to all of this thing, or even interesting to understand is that ये जो भी ट्रिगर्स हो रहे हैं उसकी वजह से क्या हो रहा है हमारे पोर्टफोलियो के अंदर, देयर हैज बीन लॉट्स ऑफ एक्सट्रीम फोर्स सेलिंग हैपनिंग ड्यू टू द लोन एक्सपोजर व्हिच पीपल टेक लोन अगेंस्ट द शेयर्स, और ड्यू टू द मल्टीपल मार्जिन ट्रिगर्स दैट हैज बीन हैपनिंग. सो ये सारा चीजें हम लोग ने देखा है कि इट हैज बीन हैपनिंग इन द लास्ट 6 to 12 months of time frame. Now, this is something a very really interesting data point which has been prepared by a renowned PMS company by the name of Sage One, and it is really very interesting to study and know for all of you and for all of us, right? Now, what we could understand from this thing is that for the last 10 to 20 years of study, what we had seen that almost every year in the month of January, February, and March, there has been a significant amount of correction almost happening every year in the month of January and February due to multiple of reasons. One of this could be the liquidity drain, that although almost all the corporate companies are required to pay significant amount of advance taxes before the 15th of March every year. And thus we have seen that almost in every year, the market significantly corrects in the month of Jan and Feb, and it rebounds and starts to rebound by the end of March. Now, what is really interesting and why it is really important for all of us to know is that because we are already sitting in the month of February, and we all know that how we could position our portfolio from here on. Now, the next slide and the next data point is really more interesting. अब ये हमारे हमारे लिए समझना सबसे ज्यादा जरूरी है कि ये डेटा पॉइंट क्या बताना चाहता है. ये डेटा पॉइंट ये बता रहा है कि जब जब पास्ट में, now this is the data point we have taken up from the year of 2009 till 2025, and now and अगर आपको ये डेटा पॉइंट समझ में आता है तो it would be really interesting for you to position yourself from here on, how you could really position yourself and how you could really deploy your cash and the available amount of funds you wanted to invest. Now, what we could understand over here is that every time in the past, when the small cap index, so which is the Nifty small cap index, had corrected in the month of Jan, Feb, March by more than 20%, on an average, it has bounced back to 64% every time in the past. And it has happened almost in every consecutive year. And this is something we could even see in the data points. You could see that in the year of 2009, in the month of Jan, Feb, March, the small cap index corrected by 20%. And in the subsequent next 1 year, till the time the top was made, the small cap index made the highs up to 176%. Same thing happened in the year of 2020. The small cap index significantly corrected up to 47% in the Jan, Feb, March, and in the subsequent starting year, which is the next fiscal year, starting from the April, it bounced back to 154%. Now the same thing had again happened in the year of 2023. The small cap and mid cap index significantly corrected by 11%, and just in the next fiscal year, within a period of next 1 year, it bounced back to almost 90%. Now this is something really interesting for an investor, because we are starting, or we are sitting at the month of February 2026, and we had already seen that till the date almost we had seen 9 to 10% kind of correction that has already happened in the month of January. But what is interesting is, based on the past data points, is that depending on all the green shoots which are visible, which we will be going to discuss further, what we could see is that there are a higher expectation that market could bounce up to 64%. So this is something, a very interesting data point for each of you to understand the current market scenario. Now, what is really interesting again here is that, जैसे मैंने आपको बताया कि we would just not be going to talk about the budget, because the real mindset game or the psychological approach is all about the entire framework. Because just based on budget, if you would think कि अगर यूनियन बजट 2026 आया और अगर आप किसी को बोलोगे कि बजट के बेसिस पे अगर मैं कौन सा स्टॉक ले रहा हूँ, it would make absolutely no sense, because this is something not how the portfolios are built. Portfolios are built based on a strategic call, after understanding all the things kept in place and after understanding all the scenario. Because even if you really wanted to invest your money, there would be a big question that whether you should invest your money right now into the large cap funds or the small cap funds or the mid cap funds. But when you have a such an clear view that how the small cap index or the small cap companies has significantly bounced back after a significant correction, you would be really able to build your portfolio and decide the framework that where you should essentially park your money. Now, again, as I had said, that the Q3 FY26 numbers are already coming in every year, almost like every day, almost like more than 100 and 200 numbers of companies are posting the numbers. What we could see over here is that after the significant correction in all the stock prices, what we are finding right now is that the small cap index, which is the entire index, is now almost trading as less than 15 multiple at the FY27 forward P ratio. So this is again very interesting to keep in mind, that this is not the time to panic and sell your stocks, because they had already significantly corrected and right now they are available at a significant cheap valuation. This is again very interesting. We could see that the capex has almost like risen and it is shooting up significantly. Now, this is really very interesting what has happened in the last 3 to 4 months. And this is really interesting for all of you to understand the ground reality. The economy is accelerating. You would have heard, and you could also see over here, that the commercial vehicle sales, that is the very important economy signal, right? So the commercial vehicle sales has happened highest in the FY26, and it has shown like 21% year-on-year growth. If you talk about the industrial credit policy, the bank credits to industry had grown by 13%. If you could see the data points of the steel fabrication company, the India's biggest steel fabrication company, they had stated that the daily steel pipes are being sold from 8K to 15K tons per day, right? So all these things really showcase some very interesting point that what's happening in the ground reality and how the economy is accelerating right now. This is again very interesting to understand that the year-on-year growth for all the mid-cap companies, which had already posted their numbers so far, has been 18% year-on-year growth. So which is phenomenal and exponential kind of earnings growth that has been coming up for all the Indian companies, and the small cap companies across the board has so far, as on date, had posted more than 30% year-on-year growth. So again, we could understand that all the earnings are showing and are like very showing fantastic kind of numbers. So this is something which was really interesting to understand, that the budget is important, but it also helps us when we understand the current market framework, right? Now, moving on to point number 2. First, we talk about what the market is there right now, where we are sitting right now, and how we should understand the current market scenario. Now, moving further, we would be going to talk about the important thing, which is about the fiscal path, right? So this is again a very interesting data point to understand the entire macro framework. What we had seen is that the government had stated the fiscal discipline and the ratio of fiscal deficit has been constantly going down since the last 5 years. And this is really very interesting, so that we could see that we are not growing at a country level by just taking the debts, but we are growing at a country level even with reducing the fiscal deficit levels at the country level. All right. So moving further, we would be going next to talk about the real 4 alpha frameworks or the alpha engine frameworks, about how we could see that how we could essentially frame our portfolio. And first we need to understand over here that what we would going to discuss about here is nothing about the hope trade, but about clearly about the earnings trade. So right now, as we have discussed earlier, this is a phase where markets historically deliver what we had seen in the earlier slide, that this is a phase where market historically deliver 2 to 3x kind of returns if it is purely driven by profits growth. And that is where, as an investor, our focus should be. So first, we would be going to talk about the 4 alpha engines, that how we could take the advantage of the real investor portfolio based on the growth scenario, right? So the first alpha engine as an investor or as an wealth manager, you should understand is about the manufacturing and the industrial opportunity that is available. So we had seen in the budget there has been a significant and exponential capex which has been discussed for all the sectors, but the specific sector which I would like to focus over here is the semiconductor sector, the import substitution sector, and the defense sector. What we had seen is that though it was not in the headline, but if you go deep down into the budget book, what you would find is that for the defense sector, there is a year-on-year increase of 20% budget allocation in the defense sector. Essentially, all the stocks had not significantly performed even after the budget, because what we have seen is that the sentiment right now is on the downward side. But it is really important to understand that the opportunity as an investor are into those stocks where the order book is very strong, where we could see that the order book is significantly visible, and we could have a revenue visibility for the next 3 to 5 years out of those order books. And again, as we had like heard multiple number of times, and we had seen that India right now is completely executing the China 2000 to 2010 playbook. So what we had seen earlier is that we are currently building the entire domestic industrial capacity at scale. And what we are seeing is that the import substitution right now we are seeing is building the entire next generation of multi-bagger. And I'm sure that this budget would be going to clearly provide the structural roadmap and the growth plan for all the small caps, micro caps, and the mid caps companies. And if you really found those real interesting opportunities and early pick those opportunities into your portfolio, you would be really going to make lots of multi-bagger over the period of next 3 to 4 years. So this was the first alpha engine which we must understand. Now the second alpha engine, which as an investor you all must focus, would be about the railway modernization and the road construction story. We all know that we are already in the super cycle of the infrastructural theme that has been happening since the last 5 years. But again, if you just go to the budget 2026, you could see that even in the budget 2026, there has been the 14% year-on-year capex growth plan given for the railway modernization, modernization and the railway infrastructure companies. Also, in the budget 2026, almost like 1.9 lakh crore of allocation was given for the road construction companies. Now, we all need to understand that all the infrastructure stocks right now are essentially not a cyclical bet. Earlier, they were considered to be the cyclical bet, but right now, they are in the very significant long time earnings visibility cycle. And as soon as the government contracts and as soon as the revenue booking kicks in and the comes in, all these stocks which are like right now trading even at a single digit or a higher double digit multiple would start to deliver significant kind of performance and returns in your portfolio. So this is the second alpha growth engine which all of you need to keep in mind, which is the infrastructure super cycle. The third important alpha engine, which I feel is the most important, is about the energy transmission and power security. So this is a decadal kind of opportunity that has been focused by the current government for every trigger and for every update they have been provided. So you should must focus on the entire level of stocks which are currently working in the renewable energy sector. It might be solar stocks or it might be the wind energy stocks. So there are like a few listed and a good quality kind of national level wind energy companies. Some companies like Inox Wind or the companies like what we call the Suzlon Power, right? Suzlon Energy. So all these companies are into the wind energy sector and they are having a decadal kind of opportunity. And we could also see that government is significantly and constantly providing them the good kind of backing because the focus of the government has been very clear to move from the non-renewable sources of energy to the renewable energy sources. And with all of this thing, we should also focus much on the battery energy storage as system, these stocks. So you should focus on the entire framework of the energy transition that is happening from non-renewable to the renewable energy sources such as solar and wind. So this is again the fourth so this is again the third alpha engine which you should consider or see as an investor for positioning your portfolio from here on. Now, the fourth alpha engine is about the digital backbone. And now this is really very interesting. And we had also seen now that what is what's happening in the last 2 to 3 days also. So even if you have been an active investor, you all know that what's happening in the Nasdaq and all the technology stocks in the last 3 days. You would have seen a sharp amount of carnage that has been happening in all the US listed stocks, which are into the technology service companies, right? And the if in the and the second impact was also visible in all the Indian listed stocks, where you would have seen that just day before yesterday, the entire ITBs or the entire IT stocks was down by almost like more than 5%. So what is really interesting to understand over here is that the entire economy or the nation or the stock market framework is moving from the digital service to the AI application companies. So if you just go and see that what are the type of stocks or what are the type of companies it is, you would see if would have been the pure or the IT service provider companies, it would have been gone into the carnage or the subsequent kind of correction things because of the coming up of the Anthropic and all the other digital and the AI kind of companies. But on the parallel thing, if you would go and see the type of companies which are into the new age AI business, right? The companies into the manufacturing of the semiconductor thing or the AI storage or the data storage capabilities, right? Might be the proxy players to the data center companies or might be the proxy players to the AI application and service company. You could see the name like the likes of Moschip Technologies, the likes of the data center companies like Anantraj Technologies, or the companies like Network Technologies. You would have seen that when the announcement of the data center exemption, the exemption that would be going to be provided by the government for all the global data center companies, which would be going to manufacture their entities in India, they have been provided a significant kind of tax holidays up to the period of 2047. So this is a big boom provided to all the data center companies. And the government also has a clear plan that they wanted to really provide a significant kind of boost and opportunities to all the data center companies and make India also as an AI play. So essentially अगर आप इन्वेस्टर हो तो जैसे आपने देखा होगा कि पिछले एक साल में अगर इंडिया में सिग्निफिकेंट अमाउंट ऑफ करेक्शन आया है, तो उसका एक मेजर रीजन ये भी था कि फॉरेन इंस्टीट्यूशनल इन्वेस्टर्स के लिए इंडिया के अंदर एआई प्ले करने के लिए कोई थीम ही नहीं था. So all the investors who really wanted to play the AI theme, which is the biggest theme right now across the global, right? So all of those global investors have moved or taken out their money from India and moved to the US companies or have moved their money to the Japan, China, and all such emerging markets where they had the AI theme play. So again, the government has focused and provided the opportunity to all the companies which are working into the AI and data center stocks. Now again, the fifth growth engine, which is really very interesting to focus upon here, is the MSME formalization and financialization. If you would have heard in the budget, there was a clear specific announcement that government would be going to allocate a huge fund of 10,000 crores for the MSME, and they would be going to create the champion MSME, right? And again, they had also provided some extra kind of a 2,000 crores of fund to provide the guarantees and the trade guarantee limit to improve the cash flows and all those things of the MSME. Now, why this is really important for us to focus on? Because the government has said that we are not just considering MSME right now as the backbone of our economy, but we are seeing MSME to be the real forefront and the real upcoming heroes of the entire Indian economies. Now, this is where the entire things keeps on changing. So government really knows that over the next decade, all those companies which are very small right now are going to become very big over a period of time. So they are really providing huge, enormous boom to all the small sector companies. They are providing lots of credit guarantee facilities, lots of cash flow improvement opportunities for all the MSME companies. And again, just like the Startup India scheme, they had framed for the very small startups. This is a very big boost coming up for the entire MSME thing. Now, what is really important to understand over here is that when the government provides so much so of support to MSME, it really shows the impact to all other small cap, mid cap, and large cap companies also, because they have been essentially doing all those business with the small MSME companies. So this is the fifth and the most important alpha engine, which as an investor you must track. So what I tried to evaluate from the fine prints of the budget is that the top five very interesting and important alpha engines which you as an investor must focus on. Now moving ahead, what we would be going to conclude the session in the next 10 minutes, but this is the most important slide which I would like to discuss with all of you. And trust me, if you really understand this thing, you would be really not be required to ask anyone that how the returns would be going to flow over the period of next 12 to 8 months in your portfolio. Now, let me help you understand this thing in the most easy language. Now you could see over here the red color of circle which has been put over here. Now this is the point of maximum fear where mostly the retail investors exit. Again, this is the point of maximum opportunity where almost all the institutional investors come and they accumulate all the quality kind of stocks. अब यहाँ पे आपको ये समझना सबसे ज्यादा जरूरी है कि जब हम ऑलरेडी एट द बॉटम आ चुके हैं और नियर टू द बॉटम बेस्ड ऑन द earnings visibility or based on the valuation and based on the green shoots which already seen, we could not correct significantly from here. We might correct, let's say, maximum 5 to 10% from here. But what the maximum number of people mistake over here is that they wait for that another 5 to 10% kind of correction. And in just waiting for that another 5 to 10% kind of correction, they miss the entire upcycle rally. So this is really important for all of us to understand that this is the time for not all of us to wait for the another 5 or 10% kind of correction, where we could clearly see the accumulation being going on and the smart money being coming up by the institutional investors, and we could just not keep waiting when the entire upcycle would be about to going to start. Now again, this is the strategic portfolio allocation which I personally follow for my portfolio, and this is something I would like to share with all of you in a very simple manner, right? So this is something how you could strategically do the asset allocation or the portfolio allocation for the entire the 2026 to 2030 framework, right? Now, trust me, this is not the portfolio if you really want to make the intraday kind of return or the short-term kind of a return, right? This is a portfolio or a framework for the next 4 to 5 years of time frame, right? So over this portfolio, you could see that we had structural themes which were discussed in the past. You could allocate almost like 40% of your portfolio into those structural themes. you could allocate 30% of your portfolio into the infrastructure and the manufacturing companies. It might be the transmission company, it might be the EPC company, the wires and cables companies, all those kinds of companies which take part in the entire India's growth story and which are essentially the manufacturing companies. The 30% of your portfolio allocation must go into the infrastructure and the manufacturing companies. It might also include some kind of defense companies also. The 10% of your portfolio must stay in the opportunistic or the special situation ideas, right? The companies that might be coming up with the demerger and such kind of things. So there are like lots of companies, if you know, if you are, or if you have been tracking the companies by name or the likes of Vedanta, the Triveni Engineering or the Solara, such kinds of an opportunistic situations are right now helping, and you could evaluate the special situation themes, and you could allocate 10% of your money into such opportunistic or the special situation themes, and 20% of your portfolio must go into the financial beneficiaries. This includes by the likes of all the banks, NBFCs, by the names of KFINs, the RTAs, the wealth management companies, 361, Nuvama, and such all other kinds of companies. So these are the financial beneficiaries companies, because as and when the India's growth story begins, the money goes into the capex. The capex essentially turns into the private capex. It eventually boils down to the savings of money into the hands of the people, the middle class people, and essentially all those monies eventually goes into the SIP. So the entire economy, which is into the financial sector, would be going to uh, grow over a structurally over the next 5 to 10 years of time frame. So this is how you would structurally allocate your portfolio for the next 4 to 5 years based on the framework of the current market scenario, based on the framework of the guidelines or the extracts of the budget 2026. So this was all about budget 2026. And the last but not the least, the last slide, which I feel is the most important slide. जैसे हम सबको पता होता है कि क्या करना है, बट मोस्ट ऑफ द टाइम्स हम सबको ये नहीं पता होता कि क्या नहीं करना है. सो दिस इज द मोस्ट इंपॉर्टेंट स्लाइड, द रिस्क मैनेजमेंट एंड द अवॉइड चेकलिस्ट. सो आप सबको पता है कि कैपिटल ग्रो करना इजी है, बट कैपिटल को प्रोटेक्ट करना उससे भी ज्यादा डिफिकल्ट है, करेक्ट? सो व्हाट यू हैव टू डू, वी आर डिस्कस व्हाट यू नॉट हैव टू डू इज दिस प्योर 4 थिंग्स. सबसे पहला चीज, नो ओवर लिवरेज, नेवर गो इनटू द डेट पाइल्स. कभी भी हमको लोन्स लेके या तो एमटीएफ के फैसिलिटीज लेके ऐसे कंपनीज में इन्वेस्ट नहीं करना जहाँ पे हमारे मैक्सिमम और मल्टीपल टाइम्स पे स्टॉप लॉस ट्रिगर होते हो. सेकंड, नेवर गो प्योरली इनटू द मोमेंटम स्टोरीज विदाउट द अर्निंग कैपेबिलिटीज. मेनी टाइम्स वी कुड हैव सीन दैट काफी स्टॉक्स चलते रहते हैं अपने अप साइकिल में, बट जहाँ पे कोई अर्निंग विजिबिलिटी होता ही नहीं है, जहाँ पे प्योर मोमेंटम होता है. एंड वी हैव सीन that most of the times investors, when the momentum goes away or when the momentum vanish, the money of the investors goes badly stuck in all those companies. Third, go away from speculation, avoid futures and options. ऐसे भी गवर्नमेंट ऑफ इंडिया ने क्लियरली बोला है और डिफाइन भी किया कि उन्होंने एसटीटी बढ़ा दिया है फॉर ऑल द फ्यूचर्स एंड ऑप्शंस. So anyway, the STD is hiked substantially. So third and the most important our checklist is stay away from the speculation thing. And fourth, but most important, is the generic hype. Stay away from all those sectors which are in the limelight, which are in the buzzword, but there is no government backing or where there is no earnings visibility. So just follow all these 4 checklists. Just keep in mind the earnings framework or the current market data points which are like shared with you at the start of this thing. And trust me, if you really follow all these things in a very strategic manner, you would be going to end up making a decent enough kind of returns. Starting from here, we are sitting in the month of February 2026. And I'm sure if you really follow all these things in a structured and in a disciplined manner, you would be going to end up making substantially good kind of returns for a portfolio and over the next 5 to 10 years of time frame. With this, I would like to conclude my session because also we are at the end of the timing, and this is the final outlook. The foundation has been laid by the budget 2026. It is a clear structural growth accelerator budget, and the horizon is really the next entire decade. So years from now, this is something I would like to end up with, that years from now people will say that 2026 opportunity was obvious in hindsight. Today it feels scary because all of you would not be able to go deep down and understand all these data points. So today it feels scary for all of us to deploy more money. But this is how the great opportunities always look like. Thank you. With this, I would like to conclude my session. This is about me. I'm an like a full-time investor. I share lots of my thoughts on my Twitter handle and a few of my communities where I keep on sharing all my thoughts. If you really wanted to connect with me, this is my number. We could keep in touch. And with this, I would like to conclude my session. And if you have any of the questions, I would be happy to take a few of the questions in the next 5 to 10 minutes, whatever time you have left with. Thank you.
Thank you, Keval bhai. Any participant, if any questions, please put down in the chat box so we can discuss the same. Okay, I request one question. Can you guide for the gold and silver?
All right. So the real super interesting question about the gold and silver, right? So for me, gold and silver is really not an thing where you should focus for the trading or the short term swing kind of a thing, because right now जो हमने देखा है कि gold has like started its journey from almost like 1.5 lakh rupees and it went up to 4.2 lakh rupees, and from the 4.2 lakh rupees it has like significantly corrected in the very short term of time frame, in just 1 or 2 weeks of time frame, to almost like 40% time, and it has now like went into the extreme volatility scenario, right? So what I would really guide you is that think for gold and silver from the asset allocation standpoint, and convert or make some of your allocation into gold and silver when it even corrects more from the SIP standpoint of time. Because we had seen that as an investor, it is really important for all of us to invest all our money, not just into equity, but into the entire basket of the varied kind of asset allocation. So park some of your money into equity basket, park some of your money into metals like gold and silver, but not at a upfront level where you think about gaining short-term returns. Because I feel that, and even like I had shared one very significant or an important analysis just like 10 days ago when the gold when the gold or silver had corrected significantly, that in the past whenever the silver had made the peak, it has significantly corrected to almost 55 to 70% from its peak. So I personally still believe that it is not the right time to go all in and invest significant or substantial amount of your money into gold or silver at this point of time. Wait for it to stabilize, and we could see that how once the cycle stabilizes over the next 12 months or 15 months of time frame, you could start doing SIP into silver. But personally, right now, I am not invested into any kind of gold or silver.
One more question is there, Keval. What should be the percentage of small and mid caps in a young person's portfolio?
All right. So if you just ask me on my personal level, I am like almost invested more than 70% of my portfolio into small and mid cap companies, because this is what is my understanding. It might be different for every one of us, because when you are young, you could really give the time for the small companies to essentially become the mid companies, to essentially become the mid cap level of companies, and the mid cap level of companies to become the large cap kind of a companies. Because when you are young, your risk appetite is high, and you have a substantial amount of time left for small cap companies to become the large cap companies. So if you are really a young investor, always focus on small cap and mid cap companies. Try to go through the con calls, the promoter quality, the balance sheet of the company, the annual reports of the company, and pick up the good quality of small cap, mid cap companies, and let them become the large cap kind of a companies. This is how you should think as an investor if you're really small or if you're really a young investor. So almost like more than 70% kind of my portfolio personally is into small cap, mid cap companies. But the important thing to understand in small and mid cap companies is that you also have to exit at the right point of time. And once you learn to exit at the right point of time by using the technical analysis, you would see that your portfolio would be creating substantially a good amount of alpha compared to the other investors.
So, can we take one more question?
Yeah, sure.
Last question for this webinar. Question is that what is your views on the defense companies?
All right. So just I was reading a very excellent article on the defense companies, and this is something I could say you very clearly that defense is really not a cyclical or a short-term play. Defense was and would be the structural kind of a play for the next 5 to 10 years. And what you could essentially track in the defense companies is that you should track the order book of all those defense companies which are trading right now, or the companies in the entire universe. Almost like 30-40 companies are right now in the Indian defense stocks, which are having very good kind of order book and the revenue visibility for the next 4 to 5 years of time frame. So defense is really a very interesting sector. It is also part of the manufacturing, the entire manufacturing story. So yeah, the defense is a bullish sector. Right now, if you talk about today, the stocks, most of the stocks which are into defense stock has corrected significantly, 20 to 30% in the last 2 to 3 months. Right now, they are in the structural breakdown zone. But as soon as they clear this cycle 4, the stage 4, the entire new cycle, uptrend cycle of the defense stock would be going to kick in. Maybe it might take 6 or 9 months before we start the new enter cycle of defense stocks. But yeah, you should keep a focus on the watch list of the small market cap defense companies which are having good order book, good revenue visibility, and showcasing the good amount of quarterly numbers.
Okay. So we are ending up this session. Before ending, I would like to vote of thanks. Thank you very much, Keval Shah, for an insightful and enriching session today. Your practical approach to long-term investment, stock selection, portfolio construction has given all of us a perspective that we can apply in our own decision making as an investor and as a professionals. On behalf of ITBA and AGFTC and GyaanStation, I extend our heartfelt gratitude to you for taking our time for your busy schedule to share your knowledge and experience and research-based wisdom with us. I'm also thankful to all the participants for joining us in such good numbers, for your active engagement through the session, and a special thanks to the committee who have organized this webinar. We look forward to many more such webinar with you, Keval. And thank you once again. And thank you everyone for this evening.
Thanks a lot.
We are
Absolute pleasure connecting with all of you.